If you're a current federal employee and under the age of 59 and a half, there are only two ways that you can access the money in your TSP account. One way is through a TSP loan, and the other way is through a financial hardship withdrawal. While both options may provide financial relief, they differ significantly in terms of eligibility, repayment obligations, and tax implications. In this video, I'm going to compare the two options across various factors and explain when it's best to choose one option over the other. But before we dive into the details, welcome to the Money Briefing. My name is Jarrell Harvey, and I'm with Fedway Financial. On this channel, we cover topics related to personal finance, federal benefits, and retirement planning. So if you find this video helpful, please consider sharing and subscribing. The structure and the rules related to the TSP are designed to help you save for retirement. So taking a TSP loan or hardship withdrawal will come with some consequences. However, they can be a timely source of funds for managing unexpected circumstances or major life events. To take a TSP loan or hardship withdrawal, you must be actively employed as a federal employee or a uniformed service member. Qualifying for a TSP loan is relatively easy compared to a hardship withdrawal. You're eligible for a TSP loan as long as you have at least $1,000 of your own contributions and associated earnings in your TSP account. You must also have not fully repaid a previous TSP loan in the last 30 days and have no unsatisfied court orders against your account. There are two types of TSP loans. One is a general purpose loan and the other is a primary residence loan. General purpose loans can be used for any need without documentation, while primary residence loans are strictly for buying or building your primary home. To be eligible for a hardship withdrawal, you must have a genuine financial need. There are 5 acceptable reasons that qualify as a financial hardship. Those 5 reasons include having a recurring negative monthly cash flow, having unmet medical expenses due to an illness or injury to you, your spouse, or dependent, having personal casualty losses due to sudden or unexpected damage that may be caused by an earthquake, hurricane, flood, fire, or some other type of similar cause. You can also qualify for a financial hardship under this item due to property theft or automobile accidents that are not caused by your own negligence. However, any type of personal loss that comes from a bank failure, business failure, or normal wear and tear would not meet the conditions as a hardship. Another thing that would qualify is having unmet legal expenses that may be related to a separation or divorce. And lastly, any expenses or loss from a major natural disaster declared by FEMA would meet the acceptable requirements of a financial hardship. When applying for a financial hardship withdrawal, you don't need to submit proof of income or documentation of your hardship, but you do have to attest under a penalty of perjury that your reasoning is true and factual. You should also retain documentation about your hardship for future reference. In regard to distribution limits, the minimum amount that you can take as a loan or withdrawal is $1,000, but the maximum amount that you are allowed to get from each option is different. For the TSP loan, the maximum that you can borrow is based on 3 different tests. I won't go into detail about each test, but the loan limit is capped at $50,000 regardless of your account size. For a hardship withdrawal, you can only withdraw money from your contributions and the earnings on those contributions, but there's no specific dollar limit. Even though there's no stated limit, your withdrawal amount should be limited to your financial need. When calculating your need, you cannot use any expenses that have already been paid or will be reimbursed from insurance or other sources. Another difference between the two is how the money is dispersed. The TSP loan is automatically dispersed proportionally from your traditional and Roth accounts if you have both. However, with a withdrawal, you can specify the source of the distribution. You can choose to have your money come from the traditional money only, from your Roth money only, or you can take the money from both on a pro rata basis. For both options, you can only take money that is invested in the TSP core funds and lifecycle funds. So if you have money in the TSP mutual fund window, you must first transfer that money to a core fund or a lifecycle fund before having access to it. A big difference between the two is how they are taxed. For a TSP loan, there is no taxes unless the TSP loan is not paid back. However, with a hardship withdrawal, the money is immediately considered taxable income. Typically, 10% is withheld on the taxable portion for federal taxes, but this percentage can be increased, decreased, or even waived. If you choose to waive the withholding, it still doesn't free you from paying taxes on the money. You can also request a withdrawal amount up to 125% of your financial need to help cover tax withholdings. In addition to being taxable income, you may incur a 10% federal tax penalty if you're under 59.5, but some exceptions may apply to have this penalty canceled. One of the downsides of a hardship withdrawal is that it causes a permanent reduction to your retirement account because you cannot return or repay the money to your account. But with a TSP loan, you're required to pay the money back plus interest within a certain time frame. The interest rate for a TSP loan is tied to the G Fund's rate of return at the time of the loan disbursement, and your rate will remain fixed throughout the life of the loan. Generally, the loan is paid back through payroll deductions. You can have up to 2 loans at any given time. You can have one general purpose loan and one primary residence loan, or you can have 2 general purpose loans at the same time. For the hardship withdrawal, there's no limit on the number of withdrawals that you can take, but there is a 6-month waiting period between withdrawals. If you already have an existing loan, you can still request a hardship withdrawal, or on the flip side, you can request a loan after making a hardship withdrawal if necessary. The one thing to keep in mind is that you cannot request both of them at the same time, since the TSP will only process one request at a time from the same account. Additionally, when you take a TSP loan or hardship withdrawal, contributions to your TSP account will continue unless you stop them. As you can see, there are some distinct advantages and disadvantages of both options. Generally, the TSP loan will be more favorable if you have the financial capacity to repay the loan due to its easy qualification requirements, ability to restore borrowed funds, and favorable tax conditions. On the other hand, the hardship withdrawal may be a better option if you're not in financial position to make loan repayments, or if you need more money than you're allowed to borrow with a TSP loan. By weighing the benefits and drawbacks of each option, you can make a more informed decision that aligns not only with your short-term financial needs, but also with your long-term financial goals. If you received any value from this video, please click the like button. You can also subscribe to our channel to get more content like this. If you're interested in seeing how we help our clients at Fedway Financial get the most out of their money and federal benefits, please visit our website at www.fedwayfinancial.com. Thank you for watching, and we'll see you on the next Money Briefing.